All right, welcome. I just realized I was muted. So welcome everyone to Military Money Mondays, the weekly live stream where we talk about how service members and veterans can safely grow their savings, minimize their taxes, protect their families, and ultimately turn their service to our great nation into wealth that lasts for generations. So if you guys are new here, I'm Dan Farnsworth. I am your host. I'm a retired naval officer, served 23 years active duty. Now also a licensed financial professional. I own and founded Victory X Financial, and our mission is very simple. We help America's heroes build the kind of financial freedom that we fought to protect. Okay, we do that in a number of ways. We help veterans safely grow their money and protect their financial futures for their families. Hey, happy 250th birthday to the U.S. Navy, by the way. Yes, today, October 13th, going all the way back to 1775, the U.S. Navy, the finest Navy that has ever been seen, ever existed in the history of forever, is now turning 250 years old. So we want to celebrate. We're also celebrating Columbus Day today. Today is October 13th. So we are celebrating the day that Columbus arrived in the Americas in 1492. But other than that, we'll get right into it. So let's go ahead and let's pull up our presentation here tonight and see what we're going to be talking about this week. So this week's topic for Military Money Mondays: how veterans can build wealth with zero market risk. How many of y'all out there want to risk your money, right? You want to lose sleep at night worrying about what's going to happen in the markets, right? I know I don't. All right, if you don't want to lose sleep, just comment down there. Just put a comment. Just say wealth, and or just me. Whatever. But we don't want to lose any money in the market. So we operate with Victory X Financial. We operate in the safe money market space, or the safe money space, as we call it. So we want to see how we can build wealth without having to incur the risks that come with investing money directly in the markets, and that includes, by the way, TSP. So we look at good old Warren Buffett, right? What is Warren Buffett's number one rule of investing? It's don't lose money, right? You want rule number two? It's see rule number one, right? The number one rule of investing is don't lose money. Because in the end, losses end up impacting your cash flow more than your gains. Okay, I'll say that again. Losses have a bigger impact on your future cash flow in your retirement than your market gains. Okay, so a 50% loss, for instance, requires 100% gain just to break even, right? So if you've got $500,000 in an investment and that $500,000 shrinks down to $250,000, it's going to require 100% market gain in the following year just to break even. Okay, and we saw this historically. We'll get into this in a couple of future slides, but we saw this in 2002. We saw it again in 2008, a huge market loss. And then we saw it again in 2022. Now, the last couple of years, things have been a little bit shaky, but they've been on the rise. Okay. But as we'll talk about in a couple of slides here, when you're getting ready to draw income in retirement, the recovery math from a loss can be more devastating to your cash flow, and it can force choices like having to defer retirement, not being able to take less, maybe even having to go back to work, right? Because you just can't afford to pull the same amounts of money from your saved up principal, from that nest egg, as you were able to before. All right, and you risk running out of money. So let's talk about TSP. So a quick history, as you guys know, or you might know, TSP was created in 1986. Okay, it was part of the FERS system when it was introduced. And it was basically modeled after a civilian 401k, right? So it gives you the ability to, put in funds, and now under the current DRS system, which was just introduced in 2018, the blended retirement system, military members for the first time can actually get a match on their TSP. So, not a bad deal. TSP has historically had very low fees. Performance hasn't been too bad. We'll talk a little bit about some of the funding options. You guys know, if you're familiar with TSP at all, you've got your G fund, which is primarily your government securities, bonds, right? Treasury bonds. F fund, fixed income bonds. Again, these are going to sort of increase from very conservative up to higher risk type of strategies that you can invest in, and you can diversify your funds however you want. TSP. Now, when we look at the historical performance, the G fund has averaged over the last 30 years about 4%. It's actually a little under 4%. It hasn't done great in terms of overall performance, but it's stayed pretty steady. There have been years where it's been negative, only by 1 or 2 points usually. These numbers are all verifiable, by the way. You can go to tsp.gov. Maybe we'll put a link below after the broadcast here. And you can verify these numbers. You can look up every single fund. You can look up the historicals on it and verify exactly what these numbers look like, and just kind of do your own research there. So again, as we kind of track up on the funds there, the C fund is averaged about 10%. It's a little more aggressive. Okay, you're talking about equities. S fund about 9%, I fund 7%. But here's the thing, right? So all of these funds are going to ride the same roller coasters as the rest of the stock market, okay? And what we saw going all the way back to, the early 2000s, where we entered a decade that was almost as tumultuous as the Great Depression, okay? We hadn't seen downturns like that really since the 1970s, and before that, it wasn't, since the 40s, right? So the numbers that we see in the TSP are going to kind of follow that same track, the same way they are in most of the other, funds that you would invest in through direct brokerages. So now on paper, these averages look attractive. Okay, so if you were to decide to invest, okay, say the C fund is average 10%, so why wouldn't I just put my money in there and I'll just average 10%? Well, that's what we're going to talk about here in a minute when we talk about sequence of returns, right? Because averages, while they're good and they're good for, general prediction, are not always good indicators of how your nest egg is going to perform when you go to start drawing income off of it. And in fact, it can have a dramatic difference in terms of how the market performs if you have no volatility control in your retirement plan, okay? So the market's tough lesson. So in 2002, the tech bubble burst, right? After many years of what some might refer to as a house of cards, right? During the 90s, the dot-com era, right? So we saw about a 22% decline in the markets that year, overnight, right? What does that mean? If your money was invested in a lot of those equities that were tied to the dot-com, bubble, you probably lost about 20% of your savings. Okay. Now, again, it takes time to recover from that. Why? Because when your principal declines, you're now earning compounding interest on less money overall. So even if the markets rebound, even if the next year the markets are up 10%, it's still going to take you multiple years of positive performance in the markets just to get back to where you were before. And that's where market volatility becomes such a retirement killer when you start drawing income, if you're relying heavily on that income to be able to pay your bills. Okay, now not 6 years later, right? In 2008, markets tanked again at the start of what we called the Great Recession era. Okay, this was all tied to the housing crisis, right? When the bubble burst and all of a sudden, stock prices plummeted. It was the worst financial crisis since the Great Depression. The C fund alone lost 37%, over a third of its value, almost 40% of its value. So if you had built your nest egg on the C fund because your buddies told you early on in your career, hey man, if you invest in the C fund, you're gonna possibly gain 15, 20%. Well, guess what? You just lost almost half your savings. And then even if you stuck around because your financial advisor or whoever told you, just stick it out, the markets always come back. And they do, right? They always come back. but it still took you all these, let's say 4 or 5 years to get back to where you were before. And then boom, you're socked again in 2022 with another 20% hit after COVID. Okay. So every crash wiped out years of disciplined savings and growth. And it hit retirees the hardest, right? If you were 25 years old when this happened, maybe it didn't affect you as much. But if you were 65 or 70 years old and you were relying on your nest egg savings to be able to supplement your retirement, a 40% hit would almost certainly completely derail your retirement plans, or it would cause you to really have to rethink how you were drawing money off of your nest egg, unless you risk running out of money, which of course nobody wants to do. And that kind of brings us to another point, which we'll just kind of highlight for now, and we can kind of come back to, and that is what happens when Americans or just people in general start worrying about running out of money. Well, most of the time they end up kind of like socking it away, right? So their nest egg savings that they were expecting to use for things like travel and entertainment and all the fun stuff that we would do normally want to do in retirement, now they're just like hoarding it, right? They're holding on to it. And what ends up happening? They end up passing away with large sums of money that they never got to enjoy because they were afraid that money was going to be at risk, and they wanted to keep it for a rainy day. Okay, so we want our veterans, our service members, our retirees to be able to enjoy their savings, to be able to really maximize use of it, and to just create retirements that they don't have to worry about, they don't have to lose sleep on, and they know that they're still going to leave money behind for their families. They're not going to run out of money in their lifetimes. All right, so let's talk about sequence of returns, or sequence of returns risk, rather, right? What is sequence of returns risk? Well, we're talking about a danger that's posed by the order in which investment gains and losses occur, okay? Now, I know that's kind of a mouthful, but basically what we're talking about is how the market is ebbing and flowing, going up, going down, while you're trying to draw money off of your savings. Some folks in the markets, have very lucky timing. They retire when the markets are high, or they've built up a large sum of money over a long period of time. And then when they go to retire, they can kind of absorb some of the losses maybe later on. But then there's also folks that have unlucky timing. Okay. So they retire with a nest egg that's going to provide them with just enough savings, along with maybe their pensions or any other income that they have coming in. But they have just enough to be able to meet the lifestyle that they want to live in retirement. And then along comes a loss, right? So maybe they've saved up $1 million, right? And they're planning to draw, let's say, 5% of that every year. So they're planning to draw $50,000. But then all of a sudden the market crash happens, right? And they lose 30% of their savings. So now that million goes down to 700,000. Well, what's 5% of 700,000? It's only 35,000, right? It's only 35,000. So now, if you were planning to live off of 50,000 coming from your savings every year, and now you've only got 35, you might have to rethink your plans, because you're not going to be able to continue to draw 50,000. It's just not going to happen. Not if you plan to keep the money and not run out, right? So again, this is a huge hidden danger of having your money directly invested in stock and mutual funds in the market, in vehicles like TSP, and where we have better solutions. All right. Now, why market volatility is worse in retirement? Because when you're adding money regularly through your working years, market volatility can actually be a good thing, right? So you've heard the expression, volatility. Oh man, what is it again? Volatility breeds opportunity, or panic breeds opportunity, right? We've heard this. Because when the markets dip and you're still in your working years and you're still kind of in your aggressive, accumulation years, you have the ability to basically sell off shares, buy in, buy low, sell high, right? You can play that game when you're young, but you can't play that game when you're older, because now you're relying on stability more than you're relying on accumulation. So if you think of your retirement planning strategy as sort of climbing up a mountain, let's say we're like hiking Mount Everest, right? When we're going up the mountain, we've got all these backstops in play, right? We've got all this, we're going a little bit more aggressive. We're accumulating funds. If we take some hits, we can sell, we can re-strategize. But when we're talking about going down the mountain is where more people get hurt and killed, incidentally. When we're talking about Mount Everest, more people die going down the mountain than go up the mountain, right? Because they weren't planning for strategies that allowed them to basically coast on their savings after they accumulated it, right? They didn't have a solid plan. And if you go to the military's retirement planner, right, it's on the DFAS website, and you're looking up, your TSP numbers, let's say, and you're estimating the income that you're going to receive from TSP, they're going to ask you two questions, right? They're going to ask you, one, what are you estimating your rate of return during accumulation? Okay, while you're building your nest egg, what is your rate of return? And then they're going to ask you, what do you anticipate your rate of return being in retirement? And why are those numbers different? Why is it a different rate of return when you're building a nest egg versus when you're drawing from the nest egg? Well, because you don't want your money sitting in the same volatile funds when you're trying to draw income off of it. You want your money to be safe, right? So what are you going to do? You're going to take your funds and you're going to move them into, you're going to take your savings and move them into a fund that's going to protect them, right? Maybe you move it all into the G fund, right? Which is still not 100% bulletproof, but maybe you move it all in there because all you want to do is maintain, so that you can maybe draw off of those funds and not totally deplete your savings. So you might only be earning 3 to 4% a year and trying to draw 5 and hoping that you don't run out of money, right? And maybe that's your plan, and then you're not going to have anything left to leave to your kids at the end of your life. And maybe that's okay, but I think that there's a better way, right? And the plans that we offer through Victory X Financial do, in fact, offer a better way. All right. So we've heard kind of about the 4% rule. In this scenario, we're talking about, a $500,000 retirement balance, earning, we'll say, approximately 7% of the year. Now, this is not factoring in taxes, okay? Some of the strategies that we'll talk about do involve some element of taxation. They are tax advantaged. However, there's other ones that we offer that are 100% tax-free, and we'll talk about those too. But if you're drawing, again, let's say you're drawing $25,000 a year, most financial advisors recommend, 4 to 5%, to give yourself a buffer in case of market downturns. But if you get a bad year in the market where the markets lose more than that 7% differential, now all of a sudden you can't even draw $25,000 a year off of a $500,000 savings. Okay, and again, if you're relying on that full $25,000. You might have to retool your plans at that point. All right, so what is the safer option? What is the option that we recommend? So I would never tell someone to just move all their funds from one account or one savings plan that they're comfortable with, that they're familiar with, to just move it all into another plan that they're not familiar with, that they've never heard of, all just in one foul swoop, okay? Now, we have a lot of clients that do that, but I would never, try and convince someone who wasn't wholly convinced themselves to do that. What I would suggest, however, is at least 40 to 60% of your nest egg, your life savings, should be in assets that are going to be market protected. And that's what we specialize in with Victory X Financial. That's what I personally do, right? I don't invest any money into IRAs, Roth IRAs, mutual funds, stocks, bonds, real estate. I don't own it. I mean, I own a house, but I don't invest in any real estate. I don't invest in any other vehicles because my money is in market protected accounts where I know that I can't lose money. Okay. So we have a couple of options. We're going to go over these tonight. These are ones that we're just going to drill down on. We have other options, obviously, but these are the two that we're focused on for tonight's presentation. So the safer path, right? Market protected rollovers. We also call these hybrid pension accounts, okay? And we talk about these in great length, if you guys haven't seen, in our Retire Max Elite book that we published on Amazon, The Veteran's Guide to Tax-Free Wealth and Financial Freedom. We talk about hybrid pension strategies, all right? If you guys want a copy of this book, I'm happy to send you a free copy. Just type the word pension down below, and I will send you a free copy. It's on Amazon. It's about $13, but there's no reason for you to pay for it. I'll send you a free copy. Just type the word pension down below in the comments, and I'll send you a free copy. All right. So these strategies here, right? These market protected rollovers, hybrid pension strategies have no fees, no costs, right? There's no upfront costs whatsoever. Totally transparent. It's a seamless move, a seamless transfer from one account to another, right? An at-risk account to a market protected account. Now, in many cases, some of these products that we offer actually come with an immediate bonus, right? So and it could be very substantial, right? And what they call a premium bonus. They would apply that to your principal in the first year, and that can be anywhere from 10 to 15 to even upwards of 30% that could be applied to either your premium or your income base, but that's applied in the first year. Okay, so if your account, let's say you had $100,000 and you moved it over into a market protected account where it's no longer at risk, right? No longer going to be riding the roller coaster, you could get an extra $15,000 in that first year just simply for moving it over. Okay, you're going to have market loss protection that's guaranteed from day one. You will never lose a dime in any of these strategies, not one dime. Our clients who had these types of policies and these types of plans in 2022 and 2008. Of course, we weren't, our agency wasn't in business then, but we deal with clients who had these types of products, including myself. Didn't lose a dime, not one. Didn't have to lose any sleep at night worrying about losing money in the markets and my savings going down and not accumulating value year to year after that. Okay. You're also going to get tax deferred growth. Okay. So in a hybrid pension market protected rollover, you stand to gain a 15% bonus potentially, right? We've got high caps, high participation rates in the index strategies. You're going to get tax deferred growth from day one. So we're going to roll this over the same way we would into a traditional IRA or a traditional Roth account, depending on how your funds are currently allocated. And in many cases, we have the ability to generate guaranteed lifetime income. So again, this is why we consider these to be hybrid pension strategies, because you're using your own funds to basically convert into a stream of income that either one, you cannot outlive, or two, you and your spouse cannot outlive, right? So we can set these up as a joint survivorship to convert your TSP savings into a guaranteed stream of income that is going to last your entire life, no matter how long you live and no matter what the markets do in the future. How cool is that? All right. You're going to be able to keep all the gains, right? You're never going to have a down year that's going to wipe out the up years and all of that discipline and all of that hard work that you've put into saving that money. All the gains that you make on that money year to year, you're going to keep those. That's going to be protected for the rest of your life and forever on your principal. All right. So again, we're not worried about timing the markets. We're not worried about beating the S&P 500, right? These products are designed to provide financial peace of mind. And we can do this very simply. Again, there are no out-of-pocket fees on these. If we get into, lifetime income riders, they might come with a 1% fee against the principal of the account. It just comes off of the income is all. But, up front, when we're talking about accumulation, there are no fees, no out-of-pocket costs. And oh, by the way, I don't charge any fees either, right? Because since I'm not an actual financial advisor, right, there's a securities term, FINRA licensing, whatnot, right? I'm a financial professional. I'm a licensed insurance agent. I'm a financial strategist, right? But because I'm not conducting wealth management specifically, I don't have to charge fees for any of my clients, right? So we provide this 100% free of charge. We offer free consultations. And if you guys want, after this, I'll drop my calendar link in the description and in the comments so that you guys will have that. And if you guys want to book a free consultation, again, there are no management fees, no consultation fees, and again, no fees on the actual products themselves. All right, so let's look at a real world example, right? How does this apply in the real world? Now, there are different types of strategies, and we go all the way back to several months ago when we did our first big webinar. We talked about the strategies at different stages of life. We have different strategies for hybrid pensions that can start at retirement or that can start when you're planning for retirement, okay? So let's just look at one, for instance, for a 40-year-old veteran who is just now retiring. It doesn't matter what service, but we'll just call it, he looks like he's in the Air Force, okay? So we'll say he's retiring from the Air Force, and he's got $100,000 saved up in the TSP, right? And, you know, he and his wife are very concerned because obviously market volatility has been kind of a thing here lately, right? I mean, who would, here, tell you what, type volatility, right? Type volatility in the comments if you think that the markets are going to incur more volatility in the next several years, right? We've seen everything from political turmoil, international crisis, wars, natural disasters, pandemics, right? These things all affect global economics. So type market volatility in the comments if you think that we're still gonna see some turbulent times in the future. So they're concerned about that, right? They're concerned about sequence of returns risk. So they want to move their funds into an account where it's protected. And oh, by the way, they're going to get a bonus for doing it, right? A 15% upfront bonus. So their funds, just for moving it into this account, into this hybrid pension account, are going to go from 100,000 to 115,000. And then we're going to split the allocations between a 1 year and a 2 year crediting cycle, right? Now, why would we do that? Because on a 2 year crediting cycle, we generally have higher caps and higher participation rates, which means that your money stands to earn more if you defer the crediting for up to 2 years. And in some cases, we can even defer it for 3, but 2 is about the average. So we're going to split that, kind of so that you're still receiving index credits on an annual basis, but you're also receiving even larger credits on a biannual basis while you're growing your funds to be able to prepare for retirement. Okay, so we're going to capture market link gains when the indices perform well, but we're going to have zero downside risk. So you're never going to lose money in these types of accounts. So we start at 40. Let's say his wife is age 38, okay, and they currently have 100,000 in the TSP. They want to secure joint lifetime income, right? The same way we would have if we were throwing money away into the survivor benefit plan, which if you guys haven't seen our material on the survivor benefit plan, check out the content on our YouTube channel, okay? It's just go to YouTube, look up Victory X Financial. If you're watching here on YouTube, it's right here on the channel. Look up videos that we've published about the survivor benefit plan, right? It's a waste of money. Don't do it, okay? If you're coming up on retirement, much better options. And if you have money in TSP, this is the perfect solution for being able to replace SPP, okay? So by age 60, the goal is to grow the 100,000 to at least triple, if not quadruple or more that money. But based on historical market performance, we would expect to see that initial 100,000 would grow to over $500,000 by the time this veteran reaches 60 years old. Okay, so 20 years of basically just deferring and just earning credits off of the index strategies that we're allocated to. We would expect to see this account balance grow to about $550,000. All the gains along the way are going to be locked in permanently right there on the spot. They're going to be protected from any future market downturns, right? I'll say that again. All of his gains are going to be protected 100%, locked in, protected from any future market downturns. He's never going to lose them. Now, what happens when we get to age 60? Well, we've got options, right? And we don't have to make any of these choices now, right? We don't have to make them 5 years from now. We don't have to make them 10 years from now. We don't make these choices until we're right up on it, right? Until we're 60 years old. Now we've got some options. We can either leave it in the accumulation fund and we can just keep building the same way that we've been building. We can reallocate, we can rebalance. and we can just continue to build that nest egg the same way we have been. Or a strategy that's very popular with most of our clients at retirement age, right? When they're coming up, they're about 5, 6, 7 years out from retiring. So they're kind of at that retirement zone, is we do another strategic rollover into a product. It's a very similar product. It's an index product that is designed to liquidate or annuitize into a lifetime pension for the veteran and his wife. Okay. And the reason that we do that a few years before is because we want to give the new product, which in many cases has another bonus. Okay. So we've already been able to take advantage of one bonus. Now we're going to be able to take advantage of a second bonus, one that's on the income base, right? So we want to take that 550 and move it into an income strategy that we're actually going to grow it to where the income base is over $1 million by the time this guy reaches 67 years old. And from there, he's going to turn on income. And in this case, as we speak right now, in October of 2025, we have products that will produce $65,000 a year for this veteran. And if he passes away before his wife, she's going to continue to receive $65,000 completely uninterrupted for the rest of her life. Okay, so let's just put that in perspective for a second, right? I'm going to pull up my calculator here, right? Let's say that the couple put in $100,000. They started drawing income at age 67. Let's say they drew it for, I don't know, let's call it 20 years. Let's say he lived to be 87 years old. So for 20 years, they drew $65,000 a year. That is $1.3 million of income. $1.3 million of guaranteed lifetime income. And oh, by the way, it doesn't just stop with him. Let's say she lives another 2 years. You're going to add on another $130,000 on top of that. Okay. So if we add another $130,000 on top of that, now we're up over 1.4 million. We're at 1.43 million of income off of what? $100,000 initial investment. $100,000. We literally like more than 10x our money. And how much market risk do we incur that entire time? Zero. Zero. Zero is our hero, right? We had no market risk the entire time. We never had to worry about losing money. And we turned $100,000 into over $1 million in retirement. And that's on top of his pension, on top of any money that she might have coming in. That's on top of their Social Security, and it's on top of their VA compensation. Can you imagine? You now have, what, 4, 5 streams of income? Pension, VA comp, Social Security, money coming from your TSP, that's 4, possibly a 5th, right? You got 4 to 5 streams of income, and this one is guaranteed. In fact, at that point, they're all guaranteed, right? Because you got your pension, that's guaranteed. Social Security is guaranteed, right? Income off a TSP in the strategic rollover hybrid pension account, guaranteed. All these funds are being automatically deposited in your account every single month, right? Just like your pension, right? Just like your Social Security. You have taken $100,000 nest egg, rolled it over tax deferred, and you have converted it into $65,000 a year. Now, let's say he's got a life insurance policy, right? He's not even as concerned about his wife continuing to receive the income after he passes away, because she's going to receive a massive tax-free death benefit at the end. And we could also factor that in too, right? If we wanted to incorporate that strategy here, we could do that. Right. So we could set him up with a very affordable, index universal life policy that's going to guarantee her a tax-free death benefit at the end of his life. So if he passes before her, guess what? She gets a massive nest egg that then she could annuitize if she wants to. But guess what? Now he can take income at the single rate and get even more money. So maybe he's now getting over $70,000 a year that they get to enjoy for those 20 years, as opposed to just keeping it at 65 and guaranteeing it for his spouse. So again, these are strategies that we can set up when the couple is in their late 30s, early 40s, and they're getting ready to move into this next chapter of their lives. But again, $100,000 converted to at least $1.4 million of total benefit in retirement. Okay. So again, second pension, lifetime value, and we only started with 100,000 a TSP. All right, so let's talk about our second strategy. Again, if you guys have any questions on that, I don't know if we've had any questions in the comments. Let's just check. Haven't seen any yet. But if you have any questions, just drop them in the comments, okay? And if you want to go back and watch this after the fact, I mean, I'll hang out for a few minutes after we finish up here. But if you guys want to go back and watch this and you have questions even after we're live here, again, feel free to drop them in the comments. We will answer every single one of them. And again, if you guys want to book a free consultation, you can use my link above. I think I have it on that QR code. If you just go to victoryxfinancial.com, there's a link on there that says Let's Talk. You just click on that. You can book an appointment. And I promise no obligations whatsoever. We're all about education. We're all about just giving veterans the information that they need to be able to plan their financial futures. If we don't end up doing any other business, I'm totally okay with that. Okay. I just want to be able to give back to the community, and this is my way of being able to do that. It's a community that gave so much to me, and I am so proud and so honored to be a part of this and to have worn the uniform. If you guys saw earlier on Facebook, I posted a picture of myself, from some years ago on deployment. And wished, of course, the Navy a very happy 250th birthday. Again, I am so honored to be a member of the veteran community and someone who served their nation and got to wear, the nation's cloth for as long as I did. It's a true honor. So I want to be able to give back to the community, and this is the way that I do it. I help veterans to sort of learn and use the lessons that it took me about 15 years to perfect. Right. But I'm giving this to you guys as a way of giving back, and I'm teaching others how to use these strategies to be able to protect their savings and ultimately create wealth from or for their families. OK, so let's talk about the Indexed Universal Life strategy. So here we're looking at a different scenario. Maybe somebody that doesn't have $100,000 in the TSP. Maybe they have no money in the TSP. OK, that was me. OK. I didn't have any money in the TSP. So I was basically starting from scratch using an alternative vehicle to be able to grow my nest egg, right? Something that I could supplement my retirement with, but I wasn't going to do it the same way that, all my friends and neighbors were doing it, in the military. I was going to use a vehicle that I knew was going to protect it from volatility and was going to give me additional options that the TSP simply cannot give, right? So let's say we have a couple in their mid-30s, okay, and they have no retirement savings and currently no real plan, right? They're concerned about market volatility. But they know that they need to have some money put away, right? They know that, his pension alone, depending on when he retires or when he came into the military, right, is probably not going to be enough for them to just live off of, especially not right away. Okay. So they're gonna set up what we call an Indexed Universal Life policy. Okay. Now, Indexed Universal Life, if you guys haven't heard of this or you're not familiar with it, is a form of permanent life insurance that has a cash value attached to it. Okay. And how we properly structure these policies is we design them to basically favor cash value growth. Okay. So we're not doing this just to build a death benefit. We're doing this to build a tax-free cash value under IRS Code 7702. Okay. So we're not doing anything illegal. These aren't loopholes in the law that we're, slithering our way through. These are 100% sanctioned strategies by the IRS. The IRS knows you have the money, but it doesn't show up on your 1040 form anywhere because they're protected by law, right? They're protected under the TEFRA, DEFRA, TAMRA Acts, which were congressional acts back in the 1980s. And they're protected under IRS Code 7702, 72E, and 101A. Okay, so we're going to grow our money tax-free in an Indexed Universal Life policy that's going to give us additional benefits on top of just growing the funds, right? The first one is it's going to give us tax benefits. The money that we access from an Indexed Universal Life policy is 100% tax-free. Always is, always will be. Also, we have liquidity. okay, you have access to your money in an IUL. In the TSP, good luck. Okay, that's all I got to say. Good luck. You're not getting access to those funds until you're at least 59 and a half or you're retired from the military. And even if you retire, if you're under the age of 59 and a half, you're still going to be hit with an early withdrawal penalty if you take the funds before 59 and a half. Okay, so you do not have the ability. There are very few circumstances in which you might be able to borrow against it, right? But if you borrow against it, the terms for repaying the loan are going to be very rigid. Okay, there is going to be a maximum that you can borrow, and it is going to be based on how much you have in the fund. And at the end of the day, your money is still at risk in the market. So even if you borrowed at a decent interest rate and the markets dip, you could end up losing on principal with money that's currently owed against that principal, right? So that's a pretty bad situation to be in. So in an IUL, in an index universal life policy, we have liquidity. We have access to the funds, and we have the ability to withdraw or borrow against those funds in a tax-free fashion that's going to allow us to move money in and out of the policy very dynamically, at will, no stipulations, no credit checks. It's nobody's business but yours what you access the money for. Now we're here as an advisory team to kind of help you navigate and learn that process and really understand the ins and outs. But at the end of the day, it's totally at your discretion how you want to access those funds. So in this case, the couple's going to start. They're going to start an IUL policy on the husband, okay, the veteran. And from years 1 to 5, we're going to fund it at $500 a month, right? How do we come up with that number? Well, to be honest, that was just kind of an arbitrary number that I just kind of threw out there. But we tend to base it off of, roughly 5 to 10%, the way that most advisors would recommend. Okay, so most advisors would recommend taking 5 to 10% and putting it away, 5 to 10% of your income, right, pre-tax, and putting it away into a vehicle where it's going to compound year over year, uninterrupted, and where you're, in this case, going to be able to access the funds at the same time while it's growing. Okay. Now, years 6 through 10, they're going to increase that up to $700 a month, because they'll say by year 6, he's probably been promoted a couple of times, is getting more money, maybe she's working, etc. So now they're going to increase their contribution to $700 a month. By year 11, we're going to increase it again. And we'll say by year 11, they're pretty comfortable there. So at $900 a month, they're just going to kind of hang out there. They're just going to keep funding it even after he retires, all the way up to age 66. Okay. And that's another thing, too, that I want to point out is that unlike TSP, right, unless you go back to work for the federal government with TSP, you're not contributing to TSP after you retire, right? That gets cut off. Okay. You separate from the military, no more. Can't contribute anymore, right? You can still grow your funds, but you can't contribute. In this case, you can. You can continue to contribute. There are no contribution limits, by the way, okay, or virtually none, right? If we think that we're going to need to dump in $100,000 10 years from now, we can structure a policy where you could literally, from an inheritance, a sale of a property, whatever the case, another life insurance death benefit, you could dump $100,000 in with no penalties whatsoever, and you don't even have to wait more than a year or two to get it in, okay? So again, they're structuring the policy, starting at 500, increasing to 7, then increasing to 900. Okay, and we started with a $300,000 death benefit. That death benefit, by the way, is in effect from day one. The full value of it in effect from day one. Okay, so if he has 500,000 of SGLI while he's still in, he adds 300,000 of that, and that death benefit is going to continue to grow with his cash value. So he's going to start out with $800,000 now of death benefit protection for his family, and it's only going to get bigger up until we start drawing income off of the policy. Okay, so by age 67, right, we've now contributed $500 a month, $700 a month, $900 a month, all the way out to age 67 or age 66, so 33 years. We stop funding the strategy after that, and he's accumulated $926,000 of tax-free cash value, right, with a $1.1 million death benefit. And that's assuming we don't do anything else with the policy, right? We're not doing any dynamic banking. We're not doing any type of, interest acceleration with it. All we're doing is just contributing the same way we would be with the TSP. he's now accumulated over 900,000, almost $1 million of tax-free cash value with a $1.1 million death benefit. And now, because of the way that we can access these funds, and because our accumulation value is not subject to sequence of returns risk. So remember, just a few minutes ago, we were talking about sequence of returns, right? Our accumulation value in this strategy is not subject to sequence of returns risk. You're never going to lose money in your principal. So therefore, we're able to start drawing about 9.5% as opposed to 4 or 5. So think about that. 9.5% we can draw because we're confident that our policy is going to earn, our cash value is going to earn somewhere between 7 and 12, but we're never going to run out. We're never going to lose money. So we're never going to have to worry about running out of money. All right, that's pretty cool. So they're able to start drawing about $80,000 a year tax-free. Now, why is tax-free significant? Because it's going to add about 30% more value, right? How much would he have to draw before tax if he wanted the equivalent of $80,000? He'd have to draw almost $130,000, right? If he wants the tax-free equivalent or the pre-tax equivalent of $80,000 a year, he's got to draw about $130,000. In fact, we could even do the math. Let's see. Let's just pull up the calculator. So 130,000 minus 30% is going to take us down to 91. So maybe not quite. So maybe 120,000 minus 30%. Okay, that gets a lot closer. So we'll say 120,000, right? But in this case, he didn't have to worry about that. He didn't have to worry about taking $80,000 a year because he's doing it tax-free. He didn't have to worry about losing money to taxes and giving it to Uncle Sam. And he's got an additional benefit here, and that is survivor protection benefits. Okay, so unlike the TSP, where whatever's left over in your account might confer to your family, it's still going to be taxable, right? It's still going to affect their income, and it's still going to be potentially subject to capital gains taxation. But in this case, we have a completely tax-free death benefit that's going to avoid probate. It's going to confer tax-free, and it's not going to affect their income levels at all. And it's going to be guaranteed, right? And it's separate from the income that they're taking. So even if this guy lives to be 85 years old, okay, after 18 years of income, his wife is going to receive $620,000 tax-free at the end of his life. $620,000. So when you add that all together, right, the total lifetime value of this strategy is over $2 million. It's over $2 million, right? We had $80,000 a year coming out for at least 18 to 20 years in retirement. And then his spouse or his family is going to inherit a $620,000 tax-free death benefit. So we've got over $2 million of tax-free lifetime benefit. And ultimately, the plan thereafter is to just rinse and repeat this cycle, except now we're putting it on steroids, right? Because we're starting with a much higher base than we started when the couple first started their plan. Okay, so instead of starting with 0, now their kids, their grandkids, whoever is going to be potentially starting with over $600,000. Maybe it's his wife, and maybe when she passes away, she's got a death benefit that confers tax-free. And now the kids, when they're in their 30s, 40s, the grandkids younger than that are starting with a much larger sum. And this process just keeps on rolling, and it just keeps continuing. Okay, that's how we build generational wealth. That's how we take your service and we convert it into wealth that lasts for generations. Because we do this from the nuclear family starting to the next generation and the next generation. And pretty soon, after maybe a generation or two, you've now bred a family that your family is now basically millionaires, okay, for lack of a better term. You've allowed your family to become very wealthy because of your service, right? I mean, that's pretty powerful. It's pretty powerful when you think that military families, you don't necessarily think about military families as being wealthy and prosperous and elite and whatnot, right? We kind of tend to be more salt of the earth, right? More middle income. But I'm telling you, you can take these same strategies and with a very nominal contribution, you can ensure that your family lives a prosperous life for many generations to come. And we have the tools to be able to do this. The ultra wealthy have been doing this for decades, for centuries, okay? But you can too, right? And we can show you how. So again, 2 missions, 1 goal, both to achieve financial security, right? So just to kind of recap on what we just talked about. So you have the veterans or service members with TSP. Now, again, we can't touch TSP until you retire or separate. But if you have other 401ks or other private IRAs, we absolutely can incorporate those into the same strategies. So if you worked either before the military or maybe your spouse worked, we can certainly use these same strategies, and we can, do a market protected rollover into a hybrid pension plan. It's going to give you a lot of times bonuses up front. You're going to have high participation rates in the market, high cap rates, right, that are going to guarantee ultimately lifetime income with, again, 0 market risk, right? This is building our funds with 0 market risk, okay? And then for those just starting, we have the Index Universal Life option that allows you to grow your money tax deferred, access it tax free, have total liquid access to the funds while you're growing it. You get penalty free access to the funds. It's going to have a separate blossoming death benefit at the end of your life that's going to provide additional protections. So maybe if we combine these strategies, you're going to be able to draw more income off of your TSP rollover, your hybrid pension. And again, both of these strategies are 100% 0 market risk. So 0 is our hero in both of these strategies. 0 risk, and you've grown your funds to exceptional levels and provided yourself with a very healthy retirement that is going to give you financial peace of mind and allow you to sleep soundly regardless of what's going on. I don't care if the world's burning, you're still going to be able to live the retired life that you want and be able to plan and be able to travel and do all the awesome things that you've been waiting on that, maybe our parents didn't get to enjoy. Maybe they did, right? But we're certainly going to be able to do so into the future. All right. So you don't have to risk your retirement to grow it. We can grow it safely. We can lock in gains. We can create lifetime income. And ultimately, we can build generational wealth. All right. So that's about it for tonight. We're almost out of time. So I'll hang back for just a few minutes. If you guys have any questions, I'll be happy to answer them. Just feel free to leave them in comment below. Again, we have our link up here if you guys want to check out the QR code, or victoryxfinancial.com. If you go to victoryxfinancial.com, you'll see a link that says Let's Talk. We also have our free online version of the Veterans Wealth Guide that is free for download. So if you guys want to go on there, check that out. Let us know, give us any kind of feedback. Let us know if there are other subjects or topics that you guys want to address. And like I said, I'll hang back here after the broadcast if you guys have any questions. But otherwise, once again, happy 250th birthday to the United States Navy. Happy Columbus Day. Hope you guys have enjoyed the weekend. And again, we'll see you in the near future. Next week will be another Military Monday. So mark your calendars. Military Money Mondays, 5 p.m. Eastern, right here on Facebook, on Instagram, on YouTube. Again, I'm Dan Farnsworth. I appreciate you guys being here, really, from the bottom of my heart. Thank you guys for joining us tonight. Hopefully you got something out of this, and we'll see you again real soon. So stay sharp, stay ready. We'll see you next week.